He is a professor at UNO, the director of the Institute for Development and Real Estate Research. He's a leading economist here in New Orleans in the metro area with deep insight into how workforce trends, public policy, and economic development are shaping real estate opportunities across our region. Dr. Bustamante, is there anything that I missed there?
No, thank you so much. Again, just really pleasure to be here with you all, and thank you so much for the invite.
Awesome, yeah, super excited. This is, I enjoy all of our interviews, but this is, I love the deep in the data analysis, economics of it. I really love these. So I'm super excited, selfishly, to sit and talk, and I think that's one thing I really enjoy about these meetups is I get to sit and talk to people that I would want to have a conversation with anyway, but other people get the benefit of listening in.
I know. I actually didn't want to, get the cat out of the bag. I heard, the conversation about tariffs, and I was like, let me get it. I'll wait. I'll save it for later.
Nice. Yeah. So I guess we can start there. But before we do, just give us a quick deep dive, into your professional background. What do you specialize in, and maybe what got you from where you started to today?
Great, yeah, absolutely. Every semester that I teach, I force myself to tell my students how long I've been teaching. I've done that since day one, and so I'm now year 14.
Nice.
So 14 years being a professor and doing and really the entire time I've specialized on macroeconomics for the most part. Especially, again, what's happening to the macroeconomy, to the broader economy, especially from the policy perspective, just because, that's where the action is. Policy is constantly changing. I think we kind of have a sense about that. And one of the key insights that I always try to at least provide, not just, folks that are stakeholders in the economic development community, but also, folks in government and really, just anybody who is interested in policy. What direction the current set of policies are taking us, and hopefully, if somebody listens, where we could potentially go in a better direction sometimes.
Yeah, no, and that's a really good launching off point. I'd like to, if you're okay with it, kind of start maybe broad, talk economics, and then zoom in down a little bit to New Orleans, and then maybe real estate specifically. You talked about tariffs and all. Obviously, a lot of changes going on. What do you think? What are your thoughts on that, or what do you think is going to be the trickle-down effects?
The first thing that I would always start with is, for the past, I think every in the papers always want to publish bad news, right? And so you oftentimes hear there's a recession around the corner. Folks have been saying that there's a recession around the corner now for the past 3 years. Instead, what we've had for the past 3 years is one of the best, strongest economies that we've ever seen in this country. Whether you're looking at unemployment rates and labor market, the employment to population ratio, just any way you cut it in terms of labor market, right now it's 4.1% nationally unemployment rate. Wages are surpassing inflation and have been surpassing inflation for the past 3 years. That's on the demand side, what's happening with households and families. Incomes are up. One thing that I would just kind of, that is a bit concerning is that when you look at the actual spending, though, we know that everybody's getting paid more now and everybody has a lot more income. But when you're actually looking at spending patterns right now, it's really the top, 10, 15, 20% who are really pushing forward to the half of the spending nationwide. And so that is just one consideration to just kind of to put a pin on, which is that there is a hesitation right now to be spending a lot of that money that folks have been earning over the past 3 years. But even aside from the demand side, when you look at what's happening with the different investments that have happened across different many industries, the pandemic was, it was a blessing in disguise in the sense that it really put a spotlight on a lot of supply chain issues that I think a lot of folks in a lot of industries have been facing for a really long time. And I think now we finally have conversations about easing those supply constraints and making sure that whether it's builders, whether it's investors, that there's a path forward for them.
Yeah. You mentioned spending, and I happened to hear this recently on a podcast. He was talking about, and I don't remember the exact numbers, but that consumer spending is like a huge percentage, if not the majority of our GDP. And then that top 10 to 15% is a huge percentage of that consumer spending. Is that right?
That's right. Yeah. It's actually just the top 10% actually comprises about half of all consumer spending.
Wow.
And consumer spending is what drives our economy, right? Kind of like going, like as you mentioned, narrowing it down to like New Orleans. Like one of the biggest tragedies I think that we're experiencing here in the New Orleans metro area is the loss of population, right? Mm-hmm. And so when we think about the loss of population, primarily we're talking about not just folks in our communities, but folks who are spending money in our communities. That money's gone. I always tell folks, think about a 2-to-1 ratio. For every 2 people that leave, we lose 1 job. And that's a job that's not gonna come back. And that's, again, it's a job that it really, I think, puts into a very clear way how spending is the driver of the American economy. And that's why I think, to the extent that, we see high incomes, we see wage growth, but we're not necessarily seeing that translate into like really robust spending is a little bit of concern.
Yeah, and that population growth is one of the things I was going to talk about in the real estate side, because I think it was last year at the UNO symposium coming up, you talked about, the downward pressures on real estate and obviously insurance and obviously interest rates, right? But you kind of talked about the population loss and how that is another downward pressure that you really don't hear anybody talking about here in New Orleans. What do you think are some of the causes? Is that a policy thing? Is that like, what do you think is causing the loss of population?
Yeah, I think it's 2 parts. One of them is we've just seen like a huge migration over the past few years into like the suburbs. So like, now Hammond is its own metro area, like we've seen just like a bit of an exodus really over the past 3-4 years. And so what that kind of tells us is that, folks aren't necessarily looking to get out of the region per se. They have deep roots, they have ties here. There's so many reasons I think that folks ultimately stay. But there's something about the certain living in Orleans Parish or living in Jefferson Parish that is really, I think, putting a constraint on folks. And so when you think of what are the main drivers, not only again do we have that broader trend of people moving out of the region, but folks just moving out of the city period because they're looking for lower cost of living. They're looking for jobs in industries that fit them a bit better. When you look at the top 3 counties and parishes that folks from Orleans and Jefferson Parish are moving to, the first one's St. Tammany, but the second one is Harris County, Texas, which is
really?
Houston. And so that really tells us, so it really tells us, that we know that there's some people moving to St. Tammany and moving to the North Shore, but there's a huge swath of folks who are just going to, one of the biggest growing economies that we have in the country right now, which is Houston.
Yeah, that's a shame. I've always said, I feel like New Orleans is such a missed opportunity because you look at places like Houston that I guess you could say is somewhat of a port city, even though it's pretty far off, right? But in Atlanta, all these cities that are booming when geographically have very little going for them, where New Orleans sits on a gold mine of the Mississippi River, tourism, French Quarter, the culture, all these things that draw. And yet it just seems like we should be the New York City of the South, and we just haven't lived up to.
I think maybe 300 years ago or 200 years ago, I think we were. We were that kind of like bustling metropolitan area, metropolitan area in the country. That being said, though, what we're you kind of mentioned some of the things that we're really famous for, and some of the great highlights that have to do with living in New Orleans. the fact that we can actually point to some of these like really strong cultural figures is kind of a little bit of a tell, though, just because it reminds us how much of our economy is really concentrated in a couple of key sectors, and particularly when we think about hospitality. It employs just such a huge share. It's the biggest employer in the region when you look at it by industry by far. And when you're looking at Houston, you don't necessarily think tourism first, but you definitely think about jobs. So I think it really kind of speaks volumes to the fact that, when folks think about New Orleans, they're not necessarily seeing it as a place of opportunity, at least, job-wise or for their, futures and economic mobility. Instead, they're really looking at these other places. To your point, there's absolutely no reason why New Orleans couldn't be that. But a big part of this conversation, I think, is how do we diversify our economy? And I think this is like, you guys are like right smack in the middle of that conversation.
Yeah, man, you keep like just laying up these softballs, perfectly transitioning. One of the other things I wanted to ask you about is there's been a lot of headlines lately in positive news for Louisiana, right? We had this is more North Louisiana, but the Meta thing up north. You had the $5 billion Hyundai plant in Ascension Parish. LNG just expanded down in Plaquemines. You have the LIT port here in St. Bernard, Amazon in Baton Rouge, like all these kind of big headlines of things happening. Is this kind of a new wave, or is that part of a larger trend that we've kind of been seeing? What are your thoughts on all that growth?
This is really just part of about like a 5 to 10 year trend that we've seen that is finally catching up to New Orleans, but we've seen it in the South, as you mentioned, places like Atlanta, Georgia, Texas. That's where like it really kicked off, which is these huge, particularly international companies who are doing a lot of manufacturing investments across a lot of different industries. You mentioned steel. Also in New Iberia, there's First Solar, who's going to manufacture solar panels. You mentioned the Meta plant. This is finally, Louisiana getting a piece of the pie of these investments that we've been seeing for the past 4 or 5 years. Ideally, we would have been in front of the line, and we would have been the first one to absorb those. We would have been enjoying those jobs now, that huge bump to our economy now. Instead, we have to wait a few years for these, facilities to come online. For the most part, the timeline between, an announcement of a project and actual deployment. I mean, having folks in these factories. It gets longer every day, and it feels like at least it certainly feels like these different investments that we talk about. We probably heard something about them a couple of years ago, but we're still kind of waiting. We know that they'll be here, but it's really hard to, I think, tell people stay here a little longer. The jobs will come. That's just a really tough sell, and I think. I think the silver lining is once these jobs come online, because these are new industries to the state by and large, these are going to have some knock-on effects that are going to help develop different supply chains around those industries. And so those investments are really going to be positioning us to have further investments. So whether you're looking at car manufacturing, whether you're looking at steel, whether you're looking at LNG, there's so many other downstream supply chain industries that are affiliated with it that strategically it behooves some investors and some companies to build around that.
Nice. And you had just mentioned hoping that we would be maybe more in front of that line. What goes into it? Is that purely policy, or like what influences where we are relative to these coming here versus other places?
Yeah, I've talked to a lot of different folks who, in particularly manufacturing, just because, as I mentioned, that's where so much of investments, so many of the investments have been concentrated over the past few years. And I've been a huge advocate of just again the real potential that a lot of these investments hold. They tend to pay above average wages. They tend to be really stable jobs. Today's manufacturing is not the manufacturing of 20, 30, 40, 50 years ago. It's actually a lot more, higher end, a lot less taxing on the body. Like there's a lot better ergonomics in manufacturing, and so it is really, these are jobs that you can really build lives and families around. And so when you have that conversation of, with these companies and they tell you like, where am I going to go? They're oftentimes looking for two things. One of them is cheap land, cheap spaces, and not only just cheap spaces, but spaces that allow them to build to spec what they need. So many of these companies require, either considerable refurbishment of existing facilities or just brand new facilities overall. Going through zoning can kill these projects, and it has killed these projects in many examples. I remember I was talking to a realtor friend, a broker friend of mine, just a few weeks ago, and he was telling me the story of, he was trying to sell a lease on a industrial lot, and for whatever reason, that lot had very different zoning regulations than the lot next to it. They were both identical lots, but for just, for who knows what reason, like they were zoned differently. And so like the refrigerants or what have you and other kind of chemicals that the person the business who wanted to lease that building needed, they couldn't do it. And again, that's just like a very small example, but that is something that I think maybe many of you have probably experienced in the past, but that's something that a lot of businesses experience, and that is like one of the biggest hurdles, I think, for them to invest in places like this where, zoning can be a huge hurdle. The second part that I would just mention is, do New Orleans and in the broader area, we do have a really high skilled, highly educated workforce. It's now because we don't have that base, that traditional historical base in manufacturing. That's one of the things that really hurts us, because again, we haven't necessarily been a diverse economy over long. When you look at places like Houston, when you look at places like Atlanta, one of the reasons why these were in the front of the line is because they already had these legacy industries. Where in Georgia, for example, they had carpet manufacturing and other kind of textile manufacturing. So that kind of paved the way for both the zoning hurdles to be eased, as well as having at least some type of skill base for folks to hire from.
So I guess is it the chicken or the egg? Like, what comes? Does the industry come first or the population?
And that's what I think. What we're seeing right now is, the first round of investments that happened, about 5 years ago, those went to the places that already kind of, again, had this existing infrastructure. But now those places have pretty much been tapped dry. Like, all the investment, like they can't really, absorb very much investment, especially at the scale that these things require. And so this is where I think now for Louisiana and certainly for New Orleans, where we're now kind of like in the egg phase, which is, again, we're really planting these seeds. We're really, having these new industries emerge in the state. And again, I'm really optimistic about just the real huge potential that's ultimately going to make, not just again in making that first step in terms of diversifying our economy, but knowing that there's potentially that second step where you can now build other economies and other businesses around these investments.
Are there any industries or sectors that stand out where you kind of foresee maybe the most growth?
Yeah, the two parts the two that I would mention is, when you look at automotive, parts manufacturing, as well as when you look at solar panel manufacturing. And the reason for that is because there's huge supply chains that are associated with each of those. So once, you have a parts manufacturing plant, having an assembly plant is downstream now. Like that makes that a much easier possibility, and it doesn't even have to be from the same company. It could just be another company. But the fact that they now know that there's a skill set, a base of skills, of familiarity with automotive manufacturing, that just opens the door for other types and other businesses to come in. The same thing for solar panel manufacturing. There's once folks, both companies and the state is certainly making investments. This is happening in New Iberia, so a lot of this is going through the University of Louisiana Lafayette, but also the technical school system. But these investments are happening now, and the real payoff is not just when those jobs come online, but when other companies around the world, because a lot of these are international companies, get wind that, New Iberia and Lafayette is open for manufacturing now. That you have, manufacturing happening, in Hammond or what have you. And it's just, that's, I think, like the real promise of like the potential of the supply chains that will eventually follow these investments.
That makes sense. So I guess shifting slightly, going more micro here in St. Bernard. It's I think locally, a somewhat controversial topic, but in, more wider circles and certainly in economic circles, there seems to be a lot of like optimism and, opportunity around the LIT port that's being talked about here in St. Bernard Parish. I'm curious your perspective from the economics side. What can we as investors, like if that does come, what opportunities would we maybe look for? What should we be looking for if that does come as real estate investors?
Yeah, and I think that's this is again why I'm kind of always, like I said, really bullish when it comes to these investments, because I think you can just look at other similar ports in other cities, the ones that have received some similar types of investments. And I think already that's like a glimpse into like what does the ecosystem around those facilities actually look like in practice. And I think that is really telling. The reason why the way that I always kind of think about it is, you have you buy a car, now you have to buy car insurance, and now you have to buy gasoline. Now you have to take your girlfriend or your wife out to dinner in the car, right? And have to pay that bill. Like there's so many downstream, consumer spending and demand that actually happens from like one initial purchase, one initial investment. And so really, I think it behooves folks to take a look at, not only what ecosystems currently exist around ports like these, but what potential ecosystems can coexist with them as well, because I think that's what if you can anticipate some of the demand pressures that are going to be eventually building, being ahead of that curve, I think is going to be really paying off.
Any examples of ports or anything stand out front of mind?
Yeah, it's regarding the scale, it's kind of just like a little tricky, just because it is predominantly focused like at industrial. And in a particular scale of industrial, but one of the ones that come to mind to me is looking at like the I think it's Rhode Island, I believe, or Delaware. I just forgot. I kind of confused both of them right now. But that to me, they have had some recent port investments. Not Baltimore where the bridge happened, not that. But some of these, but in that general area where you've seen a huge capacity of for greater shipping, greater industrial shipping, and that's happening, hand in hand with other kinds of investments around, offshore wind and things like that.
Nice. And I guess to pivot a little bit, we've talked about a lot of the good news, right, with these different infrastructures and industries coming in. We'll pivot to maybe something that's not so good of news. Obviously the real estate market here in New Orleans has had a tough 2-year stretch, right, with interest rates and insurance prices. Do you think we've kind of seen the worst of it, or do we still have, you think, kind of a tough road ahead?
Yeah, with real estate, as you all know, it's usually feast or famine, right? Like, you think of how terrible the past couple of years been, but how good were those like 2 years before that, right? So just kind of putting it in that perspective. But that being said, right now, we're really, I think, we're in such a consistent state at the very least, right? We kind of had these huge interest rate hikes, there was a possibility that we were going to kind of like ride the roller coaster downward with interest rate cuts.
Yeah.
And that's what I think I was expecting, a lot of folks were expecting. But then the Federal Reserve basically chose not to go in that direction. And part of it is like, they sense some economic uncertainty stuff. They want to basically be able to cut rates later if they need to in a much deeper way. But all that being said is, right now we have the past 2 years of knowing what the market is, and I think that's kind of like, there's really, you never know when you turn the corner there's going to be a cliff. Like, no one can really anticipate that, but we know that that we're turning this corner after these past 2 years, and we know that the road ahead at least isn't full of gravel or nails or what have you. Like, we know what to expect, and it's really, I think, having you all gone through the past 2 years, like, you recalibrate, you adjust, you make those adjustments, and I think that's kind of like the status quo where we are right now. There's really nothing that suggests that we're going to have a recession or there's going to be a bunch of interest rate cuts. There's nothing that's really signaling that that there's going to be some type of swing one way or the other. You're right. We don't know. We don't have any huge real estate developments for the most part that are set to increase the stock of either housing or commercial real estate at any significant clip. And so, right now I think it's just keep writing it out. Eventually, as I kind of keep alluding to is, we know that wages and incomes are up. I think once folks also get more comfortable that that the economy is not as perhaps fragile as a lot of folks keep saying it is, then that should unlock, I think, a lot more, when not just in terms of consumer spending, but certainly as it pertains to being looking at real estate in a very different light.
Yeah, and you've kind of touched on a lot of the downward pressure. And I think one thing that's been surprising for me is that we haven't seen that big drop in, obviously transaction volume has fallen off of a cliff, but we really haven't seen prices drop, and maybe slightly, right? Nothing crazy. Why do you think that is? It seems like we would have seen some pretty significant price drop. Like, if you would have rewinded and said, hey Mike, over the next 2 years, you're going to see interest rates go from this to this and insurance premiums go from this to this, I would think for sure that prices would have plummeted. Why do you think that hasn't happened?
It's my guess would be kind of going back to one of the initial conversations that we talked, the initial points that I made about the broader economy, about how much consumer spending is really concentrated on like the top 10% especially, but top 20, top 30. That's what's really keeping things moving. That's still, I think, what is really, preventing any kind of like, bigger shift in the market right now. When you think of, especially again, folks who have high, not just have high income, but high savings. They're not necessarily just looking for homes for them to, live in, to upgrade their homes, but they're also looking for investment properties. They're also looking for, that's something that I think has emerged over the past couple of years in a lot of different cities, in a much more profound way than we've had in the past. Having a new class, I think, of folks who are really interested in looking at real estate as true investments in a much more, I think, broader way.
Very nice. And have there been, if you're thinking back at kind of the data over the last couple of years, has anything stood out, whether it be, a subsection of the market or a geographic area or a type of housing or a price point, but has anything stood out as maybe more or less resilient than others?
Yeah, and where we see the resiliency is really on these kind of higher end markets, which I think, again, it really underscores the fact that, that there is still this class of folks out there who are spending money. It makes, I think, if you drive around the more affluent neighborhoods in any community, you're going to see that there's a disproportionate share of listings in those areas. And I think, again, a big reason is because the demand's out there for it.
You know, we've seen the data come out of there being kind of a little bit of a surge with FHA foreclosures, VA, you know, these types of government-backed loans, which I think lines up with what you're saying, because those are generally lower income, lower credit score. You know, they aren't getting approved for other types of loans. So it would make sense that, you know, we're seeing an increase there, but maybe not on other types of.
Exactly. Yeah. You know, so interest rates are a big hurdle for a lot of folks, but I think, you know, folks overstate the real impact of that interest rates ultimately have. And the reason why I just say that is because, you know, most people are, you know, whenever they decide to buy a home or you know, or any kind of property, most people, the first thing that they think of is, what's the interest rate? Most people think, how much money can I afford to pay on a monthly basis? And I think that's kind of like the prism I think that a lot of folks ultimately have. And as I mentioned, you know, incomes have been increasing, wages have been increasing. That's been helping that, you know, folks do that math. So one, I would say, is that, you know, interest rates do matter, but not as much, I think, as it matters for developers, where like, you know, a quarter percentage point like makes a huge difference in terms of like the bottom line. But you know, when you look at you know, interest rate, you know, like just the capacity of folks being able to buy real estate, like, that's really, I think, what it ultimately comes down to. And again, it's, you know, we just see it across the board that right now there's you know, right now consumer sentiment in the U.S. Is the lowest it's been since July 2021, which is like, you know, when we were just like starting to ramp up inflation really bad, right? That's when we were, you know, like 6%, 7% before we peaked in September. That's telling that, like, you know, people are really jittery right now. You know, my 2 cents is, you know, I think the media plays a little bit of a part of that. I think, you know, again, but I think it's overstated, the fact that, you know, how strong the economy is right now and how resilient it's been. And we've been able to sustain it for the past 3 years.
Yeah. Which translates to investors for rates higher for longer, right?
That's right. Yeah, and you know, I go back to, you know, we've been in this space for the past 2 years. There's nothing indicating that it's going to change in any kind of drastic way. You know, we initially, the Federal Reserve had predicted 4 interest rate cuts this year. 4, like, you know, maybe more, maybe less, but like 4 was like the midpoint. Now they might not even do 1. Like, and that's where we are right now. Where, so again, you know, they're showing their cards. They're putting their cards on the table. They're, you know, they say, you know, just keep it going as it is, unless anything drastically changes. When again, you know, the conversation with like tariffs as an example, it's, you know, tariffs raise prices, absolutely, but, you know, kind of, I say it in the same way of interest rates, which is, it really hurts the core sector of folks who are doing the building, who have a 10-year time horizon, because it really matters what costs are at the starting point of any given project. But not every industry works that way, and so the industries that have a much shorter time horizon, and certainly, you know, for most consumers, the time horizon is you know, this week. So I, you know, like for those folks, they find ways to manage with these kind of pressures.
I'm curious, in terms of builders, do you think that the increase in prices for lumber and copper, all these things, do you think that that'll put upwards pressure on real estate prices, or do you think it'll just compress profits?
Yeah, you know, right now, what it has been translating to is not building. That's like, it's just postponing projects. You know, and we've seen many different iterations of this. it wasn't so long ago that, a lot of builders were citing construction costs, like wage costs. Like that, the labor aspect, the price had increased drastically over the past few years. Again, they find ways to manage. Right now, then after it was wages, after wages it was interest rates. After interest rates, it's now materials. As I mentioned, these are 10-year, 15, 20-year time horizons for these investments most of the time. What we see is folks hold off on those investments for as long as they can to see if a better market opportunity presents itself, or if just the economic climate shifts a little bit in their favor. But at the end of the day, capital is going to get to work, and so as you mentioned, is how that translates into like higher costs or lower profit margins. It's kind of too soon to say, but again, from the conversations that I've had with folks is they've been dealing with the high interest rates. There were already some material costs like fluctuations in the past couple of years. It's really now that they've accepted that like this is a new normal, and I think you're going to start seeing these developers like just come back in a way that you would assume that interest rates were 3% or 2%.
Interesting. And it's this interesting catch-22 for real estate investors, right? Because on one hand, you want lower interest rates, but typically that comes at the expense of a poor economy, where some sort of recession where tenants are having a hard time paying rent, and there's a lot of other negative things. So I guess we lived through an era where we kind of had our cake and ate it too for a little while post-COVID, but now we're just back to reality where you get almost one or the other, right?
Yeah, and this is kind of where the United States is in a relatively unique position relative to other advanced economies around the world. Is that if we think about the financial crisis and the Great Recession that we had a 10-year recovery. We had sustained job growth, wage growth, and sustained low interest rates for about 10 years. That's not great. Like growing slow, recovering from a recession in a very slow, gradual manner. Like I said, it helps some people, but it hurts the great majority. What we had is, we're kind of victims of our own success, where we had the fastest recovery from the recession than any other economy. But we also had every other economy also experienced inflation. But one of the big challenges of just having this huge upswing from where we were with the pandemic is interest rates. That's why we got these interest rates just jacked up at such a quick pace. And I think folks just needed a lot of time to adjust.
Yeah, absolutely. I'm curious, are there any investment types or geographic areas or types of real estate that you think is going to grow at a pace over the next couple of years better than the others? Or asked differently, if you had, let's say, $5 million to invest in real estate today, does anything stand out where you might put it?
Yeah, and yeah, absolutely. So as I kind of mentioned, look at where these large-scale manufacturing investments are happening. Like every developer should be building around those plants, or at least in the vicinity of those plants right now. Every homeowner should probably be doing some renovations in their house so that in 2 years' time or 3 years' time when these projects come online, there's going to be a huge demand for property in these areas. And so, part of it is, as I kind of mentioned, these are when investments have multiplier effects. Investments, spur other economic activity. They spur other investments as well. And so, if you look at where some of these large-scale investments are happening, there are places that historically have never experienced a plant that is going to hire 200, 300 folks and pay them good salaries. Like that doesn't happen very often. And so I think to the extent that you can, target the surrounding areas, both the existing developed areas around these plants, but also, what are some potential areas that may be open, again, as I mentioned, zoning, but that may be open to development in the future. Something that I would also kind of just say is, if I had the $5 million right now, or any amount of money like that, is any area that that is in close proximity to any other, any open area that is in relative close proximity to a metro, buying those lands, because these data centers, it's not just, we're not just going to get one. It's not just going to be Meta. Again, we are going to get more. The way that where technology is, and we've had, a lot of folks say, we've had this jump in innovation with AI technologies, right? But one of the things that oftentimes gets underreported or underspoken is that those technologies require a whole lot of energy. They require a completely different energy infrastructure than the one we currently have. And so, I think, you might have read in the papers with Entergy, right? Entergy is already, trying to build a new plant, in order to be able to supply Meta. And so, what would that building out look like? What are the places that that you could imagine where there's going to be these data centers? And I think those are those are places where you're going to turn a profit next week or next month. Mm-hmm. But these are going to happen, and it's a matter of the other part I would just say is a lot of this land is already kind of consolidated into a few different landowners, as we know. Yeah. And so, part of it is, how is there a mechanism to kind of break some of that up?
Absolutely, yeah. And to your point about Meta, and then Entergy built a plan, so now there's more workers there, right? More housing needed. I remember I think it was the UNO event this time last year. There was a panelist, and one of them talked about, I guess he was in school during the port of Charleston being built or whatever, and he was like, yeah, the port came, and then Boeing set up shop next door, and then from there, all these tertiary businesses wanted to be close to Boeing, so I guess similar to what you're saying there.
Yeah, and this isn't, it's not because, of any, there's rationales for it, we kind of have this, this there was a period, I think, for maybe 5 to 10 years where everybody wanted to be the next Silicon Valley, including New Orleans, right? And the idea there was very similar, though, right? Which is if you start making some investments in some smaller companies, and hopefully those start attracting other companies. The logic behind that, even though again there's only Silicon Valley, right? You can't really rebuild that, but so that was a fool's errand in many ways. But the logic behind that is sound, which is, if you create the resources, if you have the skill set, if you have the infrastructure to be able to absorb these investments, you're going to make folks, make investors, give them a much easier time of finding you, and knowing where to put their money and where to put their facilities.
Absolutely. I want to make sure we have some time in case anybody has any questions, but so I'll kind of land the plane with this question. I'll put you on the spot. In terms of New Orleans metro area real estate, what does your crystal ball say for the next 12 to 18 months?
Yeah, as I kind of mentioned, I'm all in with just very, very slow, price growth in like again in your above average price, properties, while the below average price properties are probably gonna have like a little downward pressure, and it's only a downward pressure just because I think there's gonna be a lot less demand right now. You think of again, a lot of folks who going back to zoning, maybe Airbnbs, maybe like a lot of those properties might be going online, the concentration of those properties aren't in uptown New Orleans, right? So if you kind of look at where both supply is potentially going to open up and where demand is going to recede, it's kind of these same neighborhoods. And so, I think for the 18 months is we're just going to kind of see this two-track market. The higher end market's gonna be fine. I think they're gonna do exceptionally well. I just think it's really a reflection of the broader consumer patterns that we're seeing nationally.
Very nice. That makes perfect sense. Hey, I'll give it a hand for